So the question is, what exactly is an ABCD pattern? Well, an ABCD pattern starts off with the first leg, which we're going to call A to B. And I'll draw this here from point A to point B. Now then you get a retracement, and that retracement usually doesn't go higher than point A. So we get a second move up that looks something like this. And then for the CD leg, the last leg is assumed to complete somewhere in the ratio of 100% of AB to CD. Now, there are all sorts of different ratios that you can have here. So this ratio can be 0.618, so AB A to C can be 0.618. It can also be 50%. It can also be 0.786, and there's all sorts of ratios which are supposed to forecast the formation of point D. But in my experience, the patterns aren't as successful as you would expect. They're only about 32% successful. So consequently, how do we sharpen these patterns up? There's a couple of ways that we can actually sharpen these patterns up, and as you can see that this is the hour chart, and I'm going to actually draw your attention to an ABCD pattern which I can see very clearly on the chart. If we drag this across to here, we've got point A, we've got then point B, which is here, and then we've got point C, which is just a pullback there. And then finally we have point D. So that is a valid ABCD structure on the hourly chart of gold. So the creator of these patterns said that you enter at D when AB and CD are equal in length. So AB to CD equals 100%. However, that's not how I enter the patterns. So we've gone much closer into this ABCD pattern, and we're just going to measure a couple of ratios just to prove to ourselves that the ratios that I suggested, the 0.618 and 0.786, are, I wouldn't say essential points of this pattern, because I actually realize that what's actually happening in this pattern is manipulation, and we'll get on to that later. But if you're just using Fibonacci, you can see that that retracement up there was 0.618, and then if I measure from the low of B, turn my Fibonacci tool upside down, I should see something like 127% or 1.618, which is precisely what we got. Now the question is, what is really going on with this pattern? Well, we have a liquidity area that's underneath here. The market was going up and we pull back. So a lot of people who would be buying that market would actually put their stops underneath point B, because that seems logical. It's the last place that the market pulled back to, and this would be an area that I would think was liquidity. So point B is a liquidity point, and what we know about liquidity is that liquidity likes to be taken. So point D is a liquidity run of point B. So if we look across on our left hand side, we're looking for some interesting structures which we can attribute to market structure. So we know that when you have a black candle, a down candle, in the middle of a push to the upside, this is where the traders in the market were trying to go short against the market makers, and they just didn't have the energy to push the market down. Market makers stepped in and brought the market back up. So this wick here, this push up, the liquidity block where they tried to push it back down, we've got this area here which is a liquidity wick, and that's also under point B. So that would certainly have me interested in this market around about that level, which funnily enough is exactly where the CD leg would terminate. So what else can you see in this structure here? Well, you can see that as the CD leg pulled down into the aqua box, which was the wick, you can see that there was a very large reaction rally from it, and it looked to all the world like that market was going to take off. So again, that wick would contain liquidity, and I would definitely mark that. You can see we're actually hunting closer and closer into this turn, and we're excluding areas where we wouldn't expect the turn to happen. Now the other thing I can see very clearly here is we got a very big hard push down candle, and this is something that the data suggests is the crucial component part to actually establishing the reversal level for the CD leg. This big move, which had zero follow through, tells you that the market makers are not interested in lower prices. In fact, that looks like a buying candle, because the market makers pushed it down so hard, but it had virtually zero follow through. So the wick of that buying candle is very important for us. Now very often the market will come back and retest a level, and that is the safest entry to actually take. It's not the initial push down, that's almost like catching a falling knife. It's the push to the upside and then the pullback. So we've got this big black candle that couldn't go any further. We then have a wick formation. Again, you could use the half wick for entry, which would give you a precise entry at this point here, or we could simply go down to the 15-minute chart and start to explore this pattern. Now the other thing is, once you have an ABCD pattern and you have an example like this where it completes at 100%, then closes back above your projection level, these are the most successful patterns. You have evidence now that the market doesn't want to actually be this low, and so you're looking for the chance of a reversal. Let's have a 15-minute look into this structure and see what's going on. So here we are on the 15-minute chart, and you can see some very interesting examples of the market telling you that it doesn't want to go any further. We had this big black sell-off candle here. Now if you had marked that wick and tried to enter on it, you would have had not a bad entry. The fact is that it came back down and it would have just taken out your stop, but it's telling you that there's buyers in this area. So of course there's our little wick, and on a higher time frame you could combine those two candles together, and that would give us that level. So we also know that the last down candle before a move up is your order block. So this would have given us the idea that even if we hadn't entered here, once we came down, we took that low out, we had the opportunity to actually set an order. That's a big long push candle. We could have set our order to buy here, and that's possible. You could have bought here, your stop would have been below that low, and the market just took off. So once you see the structures on the hour chart, then drill down to the 15-minute chart or 5-minute chart and look for these sorts of entries. These candles are telling you a story. They're telling you that there's strength here, the way that we pushed up from here. Now you wouldn't have known that this wasn't the start of a big push up. That's not possible to know, but you can just keep getting in with small stops. In fact, when you saw this little wick here, you could have had an entry here. Would have been stopped out, but you would have got your stop to break even way beforehand. So the thing is with these entries, yes, you will get stopped out, but usually you'll lose nothing, or you'll have a break-even trade. So keep taking those break-even trades until the real one comes along. So here's another ABCD buy pattern on the 30-minute chart of gold, and all I've done is I've taken this move down, followed by this retracement, followed by this move down, which I've simply copied from here. So if that was an ABC at 100%, the market should have turned just there, but it turned a little bit before that. So what's going on, and how can we put the picture together? We know that the possibility is that this market might have turned when AB equaled CD at 100%, but in this case it was slightly short. So the CD projection leg is only an estimation, a bit like holding up something to look at it and say, yeah, I think that's about right. Now let's have a look into the price action inside the CD leg and actually see if we can put anything together. In effect, what an ABCD pattern is actually doing is it's taking liquidity, and it's taking liquidity from point B. Now, if you want to know, are we going to close above point B's liquidity, we just draw a line simply like this from point B to where D would end. Now you can see that even if you knew nothing about patterns, but you said once we get above the liquidity at B, I know that the market makers have taken that liquidity. So anywhere between the AB equals CD projection downwards, we know that this market is likely to reverse. So let's have a look in at the 15-minute chart and see what else is going on. We can see that point D went through point B and it took liquidity. At that point, the market makers were obviously content with that level of liquidity. Why? I'll tell you why. It's because we had a very strong push down candle with absolutely zero follow through. In fact, the next candle was a doji. That's telling you that actually the market doesn't want to go down, it wants to go up. So let's have a look on the 5-minute or 15-minute and see how we could have entered that trade. Here we are on the 15-minute, and you can see that this candle here at D is what I call a terminal expansion. It's a large push down which doesn't go any further. Here we had what looked like a terminal expansion, but it hadn't taken out point B, so that is not a valid terminal expansion. This one, however, is, because it took out point B and it took out liquidity. Now after that candle formed, it told you that it didn't want to go any further. Now usually I would put a order just below that low to get in, and the fact that we hadn't hit the 100% level, I would have sat my order there. But what else is going on? Well, we can see that as this candle pushed to the downside, we then get the formation of a 15-minute doji, and we know that dojis are designed to harvest liquidity. So you could have placed a buy stop at that doji low there, and literally on the next candle you would have been picked up. Now if you had used the stop, you could have set your stop below D by about 10 points, and you would have got in there with about a 40 pip stop. As the market goes up, you can see we get this expansion to the upside, and then that's it, the market retests that level again. You often see that they retest that level. So when you see the large push candle, you can put your entry on the low like that, and in this case we didn't get picked up. Sometimes it can be the body, but as I'm a bit what shall I say, stingy with my stops, I wouldn't have necessarily got in on the body, but you can. However, here we have another black down candle, another terminal candle, so you could have also put an entry stop at the bottom of that black candle just like that, and your stop would have been down there somewhere. This told you that the market was going up. This told you the market was going up, and this expansion candle to the downside, which was a nice big black candle which stopped, didn't take out that low, also told you this market was going up. So we've looked at buy ABCD patterns, so let's have a look at some sells. So this is what a sell ABC pattern looks like. Now ideally what you want is that pattern to form in a downtrend. So you have your trend coming down, you get your 1, your 2, your 3 pattern, and then you sell. Sometimes this doesn't happen, and here you have a very nice example of an A, B, C, D pattern, and if I measure those ratios you'll probably see them coming out at roughly the same that we saw on the other buy pattern. Yeah, you can see that this AB pullback leg here is 88.6. Now that means that the expansion leg should be slightly longer because you've got more of a pullback. Now at the end of the day, as I said, these are only guides. They're not actually definitive zones. Sometimes they can be extremely accurate, but sometimes the different types of pattern structure will give you different ratios. And you can have a look at the work of a guy called Mark Carey, who looks at all the various combinations of AB equals CD patterns. But I'm going to explain why I think this pattern worked. So we've got the first leg, which is this one here. So this is your AB leg. And then we get the CD leg, which comes from here to here. So we just put that one in and tidy this one up a bit. And then we come up. So your AB equals CD pattern would end up here. Now, why did that market go higher? Because there's an important reason as to what's going on, and I'll explain to you. Basically, these structures are liquidity grabs, and we know from our experience with liquidity that the possibility is that you have liquidity above this top here. So I'll put in a little dollar sign. There's liquidity there. So we put that in. We've also got liquidity sitting here. And we've also got liquidity sitting here. So if we go back to our idea of what the candles, what the story is telling us as we're approaching these termination points, is very, very interesting. So here we had a almost no wick on that candle here and almost no wick on that candle here. So we know for sure the market's going to come back and grab liquidity there. So we can exclude anything lower than that. We also have this area here where we've got a half wick, and this is also liquidity. So this is also an area I would be looking to get into the market. And then of course we've got the final termination point, which is the doji, which is just up there, the top of the doji. So if you were trading this market, you would ask yourself the question, where is the liquidity? Where can I expect this market to take liquidity? Sure, we've got a valid 1, 2, 3 pattern going upwards, but at the end of the day, this market's all about liquidity. So the ultimate liquidity would be around this previous top. So the pattern is only giving us a rough solution to a problem that we know it's all about finding liquidity. So what we're going to do is we're going to go into this section here and see if there's any other clues that we can see on a 15-minute chart. Okay, so as I have now gone on to the 15-minute chart, we can actually see the structure of this market much more clearly. So you can see we've got this huge push-up candle here. So that level there, the tip of that wick, would have been an entry for me. That would have been where I would have sold that market and looked for a reversal. Now the important thing is to get your stops to break even pretty much as soon as you possibly can, certainly after 20 or 30 pips. So I would have taken a sell trade up there. Why? Because it's liquidity, because we get this hard push candle to the top, which then fails, and then you get this little spike wick. So when I see the big long white candles, I like to put my order at the top, especially when they've taken liquidity. And although that wasn't a winning trade, it still fell 306 points. So you would have had ample time to get your stop to break even, and also even take a $10 profit as a partial profit. Now as we come up here, we come back to the same liquidity area, and we just get a little bit of reaction at it, but not much. So what I would do is sit on my pause and wait. And then as we come into this final liquidity area, we take it. And what do we get the formation of? Well, I think you've seen this enough times to actually know that this is something that we're very interested in, is a large white candle, a powerful surge candle into the top. That means that you put your entry up at the top there with about a 20 pip stop, and in this case you caught it. So you would have had two trades there, and one trade would have been stopped out for maybe $10 at a break even, and one trade would have gone on to make you a fair amount of money. I don't know how far that dropped, but this is the sort of trades that you can expect. That was a 1,624 pip trade. So we have two patterns, ABCD up and ABCD down. So let's have a look at where we are currently in the market and see if we can put any of this together. Well, we can see that the market on Friday made and I'm going to take off my zigzag indicator. We'll just put that to one side. And so this is a trade which I saw on Friday. We got a strong move up. This was non-farm payroll, nearly 600 points, and then you get this very tight little wick on the top, and that's where a sell trade was taken. Now, do we know it's going to work? Again, we don't know, but we've got a couple of things which we can do in our favor. Do we have an ABC pattern? And the answer is I can't really see an ABC pattern there, but you know, maybe you've got better eyes than I. Maybe you could say, well, this is your AB, and then you've got your BC down to here, and that would mean that you would have a pattern completion somewhere up there. Now we know that the patterns don't always go to the 100% level. Sometimes they fail at 88%. Sometimes they fail at less. Sometimes they go a little bit further. So what do we have on this chart that could maybe help us? Well, I can see this straight away. We've got liquidity sitting up here. So I'm going to put that liquidity there. We've also got liquidity sitting here. So for me, if this market did come up, and these are only projections, it doesn't mean that you're definitely going to hit those levels, I would simply draw a line from this top like that, and I would ask myself the question, are they going to come back for that liquidity? And the other level I would look at is this former top here. And again, what I'd like to see occur at either of those two levels is a strong push candle. And by strong push candle, let's find one here in the data. That's a strong push candle. So I only want to see these candles up at the top. Strong push candle, that one. That's a strong push candle. This is the strong push candle here. So a strong push candle usually has virtually no wick on the top, and usually they're quite good. So we've got a couple of levels there. One, it might just challenge the top of Friday night, or it might just come up to this level here. Why? Because we've got the formation of a rough ABCD pattern, which looks like that. Now sometimes they're not that easy to see, but that is actually there. So you can draw them from a beginning of a swing, or you can use the zigzag tool to help you find the swing points. So the US market hasn't opened yet, so we're just going to leave that analysis on the chart, come back to it later.